Hey guys, welcome to episode 8 of 10-Minute Bookkeeping. In this journey, we've covered important topics, from analyzing transactions to making journal entries and posting to the ledger. Now it's time to transform all that financial data into meaningful financial statements. Today, we'll explore the steps to prepare financial statements, delve into the process of preparing a trial balance, dive into the various income statement formats, and classify balance sheet items. You'll gain insights into how accountants refine and present accounting information. Now let's get started with the steps of financial statement preparation. These are the essential steps we'll follow to prepare financial statements. Firstly, we need to prepare a trial balance, which is a list of ledger accounts and their balances at a point in time. The trial balance typically includes 6 groups of accounts: assets, liabilities, equity, revenues, expenses, and dividends. The income statement is where we focus next. Here, we list revenues and expenses to calculate the net income and see how well the entity performed during the accounting period. Next comes the statement of equity. It informs us about changes in the owner's equity during the period and relies on information from the income statement. The next stop is the balance sheet. It is where we assemble assets, liabilities, and equity. The equity information comes from the statement of equity. Finally, the statement of cash flows is our ultimate destination. It reveals how cash changed during the period and gathers information from all the other financial statements. Preparing this statement might get a bit tricky, so we'll delve into it further in the next episode. As we go through these financial statement preparation steps, here's a useful skill for you: the consolidation of similar accounts. For example, when a company has different notes payable accounts, say notes payable, Company A, and notes payable, Company B, it's a common practice to group them under a single category, like notes payable on the balance sheet. This tidies things up and makes financial statements clearer and more straightforward. For now, let's delve into the process of preparing a trial balance. In double entry accounting, the fundamental principle is that debits must always equal credits. If there's a mismatch, it's a red flag indicating an issue that needs fixing. That's why the trial balance is so crucial. It helps us confirm whether the total debit balance aligns with the total credit balance. The preparation of a trial balance involves 3 key steps. 1. List each account title and its respective amounts from the ledger. 2. Calculate the total debits and total credits. 3. Verify that the total debits equal the total credits. If, during verification, the total credits don't equal the total debits, it's time to play detective. An efficient method is to review the journalizing, posting, and trial balance preparation in reverse order. Step 1 involves ensuring that trial balance columns are correctly added and accurately entered from the ledger. A common mistake is a debit balance mistakenly listed as a credit, or vice versa. If the error remains elusive, proceed to Step 2. Recompute each account balance in the ledger and verify that each journal entry is correctly posted. If Step 2 still doesn't reveal the error, move on to Step 3. Confirm that the original journal entry has equal debits and credits. At this point, any errors should come to light. Now, let's shift our focus to the preparation of the income statement. Income statements can take different forms, but the 2 main formats are the single-step and multiple-step income statements. A single-step income statement consolidates revenues and groups all expenses together, providing subtotals, as shown here. On the other hand, a multiple-step income statement offers more detail and provides a clearer financial picture. It usually includes 3 main sections: gross profit, income from operations, and net income. The gross profit is calculated by subtracting the cost of sales from sales revenues. For example, the Able Company's gross profit is $159,000. This section shows the company's cost control efforts. Income from operations is derived from gross profit and is then reduced by operating expenses. Operating expenses are usually categorized into sections such as selling expenses, general and administrative expenses, and research and development expenses. Selling expenses encompass the costs associated with advertising, sales efforts, and delivering goods to customers. General and administrative expenses support overall company operations, including expenses related to accounting, human resources, and financial management. Research and development expenses are linked to the creation of new products or services. When an operating expense benefits multiple sections, it's allocated appropriately. For instance, if Able Company's total salary expense in 2022 was $88,000, with $48,000 for the sales team and $40,000 for the administrative team, you would allocate $48,000 to selling expenses and $40,000 to general and administrative expenses. Income from operations is the result of a company's core business operations. Now, as a challenge, you can try to find out all the operating expenses for Able Company and categorize them into selling and administrative sections. Take your time, pause the video, and give it a shot. All right, here's the answer. Did you nail it? Let's move to the next section, the net income. It is the final figure after adjusting for non-operating items, such as rental revenue, dividend revenue, gains, and interest expense, tax expense, or losses from asset disposals. And here you are, the complete income statement in a multiple-step format for Able Company. Now it's time to move on to the preparation of balance sheets. We can categorize balance sheet items into three main sections: assets, liabilities, and equity. These three components come together to create an unclassified balance sheet, giving us an overall financial picture. However, for a more detailed and insightful view, we categorize assets and liabilities into two key groups: current and non-current. This division is pivotal, as it helps us understand when items will be converted into cash or settled. Current items are those expected to be resolved within a year, while non-current items are not anticipated to mature within a year. Current assets typically include items connected to daily operations, such as cash, accounts receivable, inventory, and prepaid expenses. In contrast, non-current assets encompass items like plant assets, intangible assets, and long-term investments. Similarly, current liabilities represent obligations due within 1 year, encompassing items like accounts payable, salaries payable, unearned revenues, and the current portion of long-term debts. Long-term liabilities represent financial commitments extending beyond a year. This classification is crucial for assessing an entity's ability to meet its short-term and long-term obligations effectively. It provides valuable insights into the entity's financial health. Now, for a challenge, see if you can classify the assets and liabilities of Able Company into current and non-current items. Take your time, pause the video, and give it a try. Welcome back. How did it go? The answer is revealed in this categorized balanced sheet of Able Company, providing you with a clear example of how assets and liabilities are categorized into current and non-current items. Congratulations! You've successfully wrapped up the first part of our financial statement preparation learning. Picture it as arranging your belongings into distinct compartments, creating a neat and easy-to-follow setup. Keep honing these organizing skills through practice. I look forward to having you join us in the next episode for more useful insights.